Investing can feel overwhelming, especially when you hear about stocks, bonds, and ETFs. But understanding the differences is key to building a strong portfolio. Stocks give you ownership in a company, bonds are like loans you give to governments or businesses, and ETFs are baskets of investments that let you diversify easily. In this quick breakdown, we'll explore how each works, the risks and rewards, and how they fit into your overall investment strategy. Today we will talk about the difference between stocks, bonds, and ETFs explained. So before we start, make sure to hit the like button and subscribe to my channel. What are stocks? Stocks represent ownership shares in a company. When you buy a stock, you become a partial owner, shareholder of that company. Stocks give investors a claim on the company's assets and earnings. They also provide the potential for capital appreciation if the company grows and its stock price rises. Additionally, some stocks pay dividends, which are periodic distributions of a company's profits to shareholders. Stocks are generally considered higher-risk investments because their prices can fluctuate widely based on company performance, market conditions, and investor sentiment. However, they also offer the potential for higher returns over the long term compared to other asset types. Stocks are traded on stock exchanges, such as the New York Stock Exchange, NYSE, or NASDAQ, making them highly liquid and accessible to individual investors. Understanding bonds. Bonds are debt securities issued by corporations, municipalities, or governments to raise capital. When you buy a bond, you are essentially lending money to the issuer in exchange for periodic interest payments, coupon payments, and the return of the bond's face value, principal, at maturity. Bonds are typically considered lower risk than stocks because they provide fixed income and have priority over stocks in case of company liquidation. However, bond prices can fluctuate with interest rate changes and credit risk. Bonds can vary widely by type, duration, credit quality, and yield. For example, government bonds are usually considered very safe, while corporate bonds carry more risk but potentially higher returns. Bonds help diversify an investment portfolio by providing steady income and reducing overall volatility. 1. What are ETFs? ETFs, or exchange-traded funds, are investment funds that trade on stock exchanges like individual stocks. They hold a basket of assets, such as stocks, bonds, or commodities, allowing investors to buy diversified exposure through a single security. ETFs combine the diversification benefits of mutual funds with the trading flexibility of stocks. Because ETFs can track indexes, like the S&P 500, sectors or specific themes, they are popular for both passive and active investing strategies. ETFs offer lower expense ratios compared to mutual funds and provide liquidity since they can be bought and sold throughout the trading day. This makes ETFs an efficient way to diversify without having to buy individual securities, spreading risk across many investments. 2. Key differences in risk and return. Stocks, bonds, and ETFs differ significantly in their risk profiles and potential returns. Stocks tend to be the most volatile and offer higher potential returns over time, driven by company growth and market demand. Bonds provide more stable income with lower risk, but generally lower returns. ETFs' risk and return depend on the underlying assets they hold. An ETF composed of stocks will be riskier than one holding bonds. Investors use a mix of these assets to balance growth and stability based on their financial goals, risk tolerance, and investment horizon. Understanding these differences helps investors build portfolios that align with their needs. 3. Liquidity and trading flexibility. Stocks and ETFs are both traded on exchanges, offering high liquidity and the ability to buy or sell throughout the trading day at market prices. This flexibility allows investors to react quickly to market changes. Bonds, on the other hand, are often traded over-the-counter (OTC) and can be less liquid, especially corporate or municipal bonds with lower trading volumes. Some bond ETFs provide an alternative way to invest in bonds while maintaining liquidity similar to stocks. The ease of trading stocks and ETFs makes them attractive for active traders, while bonds typically appeal to buy and hold investors seeking steady income. 4. Income generation. Bonds are primarily income-generating investments due to their regular interest payments, making them popular among conservative investors and retirees seeking steady cash flow. Certain stocks also pay dividends, offering income along with growth potential, though dividend payments are not guaranteed. ETFs can provide income depending on their holdings. For example, bond ETFs pay interest derived from the bonds they hold, and dividend-focused equity ETFs distribute dividends from their underlying stocks. Income-oriented investors often combine bonds, dividend stocks, and income ETFs to create a diversified cash flow stream. 5. Cost and fees considerations. Stocks can be purchased with minimal transaction fees, especially through modern online brokers offering commission-free trades. Bonds may involve higher fees or markups when bought OTC, which can reduce returns. ETFs generally have low expense ratios compared to mutual funds, making them cost-effective for diversified investing. However, investors should consider bid-ask spreads and brokerage commissions when trading ETFs. 6. Suitability for different investor goals. Choosing between stocks, bonds, and ETFs depends on an investor's financial goals, risk tolerance, and time horizon. Stocks are suited for those seeking long-term growth and willing to accept volatility. Bonds appeal to investors prioritizing capital preservation and regular income. ETFs offer a flexible way to build diversified portfolios across asset classes and investment styles. Many investors use a combination of all three to balance risk and reward, leveraging stocks for growth, bonds for stability, and ETFs for diversification and convenience. 7. Tax implications and considerations. Taxes play an important role in the net returns investors receive from stocks, bonds, and ETFs. Stocks can generate taxable events in the form of dividends and capital gains when shares are sold at a profit. Qualified dividends may benefit from lower tax rates, but non-qualified dividends are taxed as ordinary income. Bonds typically generate regular interest income, which is often taxed at higher ordinary income rates, although certain municipal bonds may offer tax-exempt interest. ETFs can have tax advantages due to their unique structure, which often allows investors to defer capital gains taxes more efficiently than mutual funds. However, the tax impact varies depending on the ETF's holdings. Equity ETFs will have different tax implications than bond ETFs or commodity ETFs. 8. Accessibility and minimum investment requirements. Another practical difference lies in accessibility and minimum investment thresholds. Stocks can be purchased in small quantities, even a single share, making them highly accessible to individual investors regardless of capital size. Bonds, particularly individual corporate or government bonds, often require larger minimum investments, sometimes $1,000 or more, which can be a barrier for smaller investors. ETFs, like stocks, trade in single units on exchanges, so investors can buy as little as one share, providing easy entry to a diversified portfolio without large upfront capital. This accessibility makes ETFs especially appealing for beginners and those looking to diversify efficiently without the complexities or capital requirements of buying multiple individual securities. The ease of access combined with low minimums helps broaden participation in the markets across different investor segments. But if you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.